Earnings are red hot, or are they?
Seriously, maybe you went to math class in school, but you did not go to reading or English class or anything like
Earnings
that.
are red, violets are blue, earnings are hot. What about you? Earnings are red hot. Who writes this way? Earnings are red hot, or are they? What do you think?
A math geek would write that way. That's how they would write that way.
Well, I can promise you that every single person on our research team has trouble talking, but they're all math geeks. They are, every single one of them is a math geek. All right, what do you think here? Are earnings red hot?
Meaning that we go higher on earnings?
Are earnings red hot this cycle? Because I have not done very well on earnings this cycle. Yes, I have not done very well.
Sure, I'll bite. I'll say they're red hot. Sure.
I would say that this, if I was just reading this right now, I would say yes. This has been a red hot earnings cycle. I have no reason to think it's not. I'm sure that this is going to show us that they're 50-50, but
Right.
Yeah, I would say they're red hot this cycle. Let's take a look. Not snow, but I would say not Mara last night.
Right.
This earnings season has been seemingly red hot, with many companies outperforming expectations to create outsized price moves. But has that been the case for the majority of stocks that have had earnings? Or the outsized moves, have they happened to be clustered in stocks that we've traded? NVIDIA up 16%, Amazon up 8%, Meta up 20%, Disney up 11%. Those are big.
Yeah, sure.
Those are big freaking Meta up 20%. It's already one of the most expensive companies in the world. NVIDIA is like the third most expensive company in the world. Amazon's the fourth.
Right.
These are huge moves. This is like moving, this is moving a cruise ship.
Yep.
Let's go next slide. After 344 earnings announcements thus far, I knew they were going to do this to me. 53% of the price moves were positive and 47% were negative 1 day's move after the earnings release. So the average post-earnings release move was nearly zero. Are you surprised by that?
I think so.
Yeah, me too.
Yeah.
Me too. Because the big ones, the ones that hurt, they moved more.
Yep.
But I guess, listen, the numbers are what they are.
Yeah.
53.47. I'd like to do that as a bet sometimes. Let's go next slide. Along with the average being near zero, the standard deviation was plus or minus 4%. 1 day's moves after earnings release, plus or minus 4%. The worst performer to the downside on a percentage basis was PANW. I think we wrote this before. Well,
yes,
actually,
no, obviously.
No, snow would be less than PANW. PANW is more than snow. And the best performer to the upside was Meta and NCLH. What's NCLH?
I don't know. NCLH, I don't think it's something we traded. NCLH. Norwegian Cruise Line. So I don't know if you know those cruise lines that are dead.
They're all going out of business. Yeah. Anyway, pretty interesting. So the average move was 4%.
Okie dokie.
Doesn't help.
No,
Let's go let's go next slide. That's interesting though, because I would not have guessed that either. Next slide, Beth. With the standard deviation of earnings events being plus or minus 4%, which translates to a distribution that is 4 times more volatile than the S&P 100. Okay, that's interesting, because the S&P 100 moves about 1% a day. So this is 4%, so you're talking about 4 times the S&P move. The average implied volatility of all earnings plays would need to be around 60 to make selling premium break even. That's just 4 times 15. That's how it gets that number. Next slide, please. So trading the earnings plays has carried very similar risk and exposure to trade. Don't look at the screen.
Go ahead.
Don't look at the screen.
I'm not looking.
As trading earnings plays and carried very similar risk and exposure, it's very similar to trading this commodity.
Trading this
commodity options. Do, 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 do. 60 volatility. You trade it.
60 volatility?
IV.
I don't know. I was going to say nat gas.
That's it.
Oh, okay. No, this is
Nat gas.
Yeah, I don't
About
trade
60
a lot of nat
volatility.
gas, but
You
yeah.
don't trade a lot, but you trade it.
Right.
NG distribution of daily returns with a 1 standard deviation line. It's really interesting that their earnings plays. So what's really great about that little piece of research is that when somebody wants to say, hey, because remember the question before, like, why do you trade earnings if it's 50? Well, because it's very much trading natural gas. And what do we say about natural gas a long time is it's really hard to trade.
Yeah, for sure. Right.
The implied volatility is 60, and the standard deviation of plus or minus 4.5% of natural gas has been nearly identical to earnings trades this quarter. That's pretty
Crazy.
good.
So you want to avoid earnings but like trading earnings? Trade nat gas.
Or you're thinking about trading nat gas but hate trading earnings, then don't trade nat gas. You better trade bonds.
That's right.
That's really good. That's good, Anton. I like that. Let's go next slide. Takeaways. Price moves this earnings season have had a standard deviation of plus or minus 4% after the announcement. Despite seeing lots of moves to the upside in some of the stocks we trade, the average price move after earnings was plus 0.4%, with 53% being up moves. So only plus 4%, which is actually nothing. And if you were to compare trading earnings to another asset, the closest comparison would be natural gas, which carries an implied volatility of 60. Yeah, that was a simple, fun segment. We have to give you an easy one the day after a Jacob Perlman session. So
That was a tough one yesterday.
yeah, that was a tough one yesterday. And the funny thing about yesterday, before the session, Jacob goes, I did a light one today.
I'm sure he said that.
Yeah. Yeah, it's good. I like it.